Hi, hello, welcome friends. In this video we are going to discuss about disclosure. So financial instruments, we are discussing about financial instruments. In financial instruments, how can we disclose these financial instruments? Firstly, introduction. India is 107 will be introduced. So India is 109 financial instruments recognition. Then India is 109 107 will discuss about how can we can disclose this financial instrument to be made in financial statement to enable users to evaluate significant financial instrument for the entity financial position and performance, and the nature and extent of risk arising from financial instrument to which the entity is exposed during the period and at the end of the reporting period, how the entity manage those risks. So we need to see what is the significant financial instrument and financial position and performance, and how much risk is arising, and how the entity is exposing that risk at the end of the reporting period we need to disclose. So significant financial instruments are entity shall disclose information that enable users of its financial statement to evaluate the significance of financial instrument for its financial position and performance. Here significance of financial instruments means in financial state we have statement of change, statement of assets and liabilities, statement of operations, and disclosures, cash flow statements. So balance sheet, statement of profit and loss account, and other disclosures. So what is there in balance sheet? So categories of financial assets and financial liabilities in balance sheet. So the carrying amount of each following categories has defined in India as 109 shall be disclosed either in balance sheet or notes to accounts. So we need to disclose in balance sheet or other notes accounts. Here financial assets will be measured at FET PL, so showing separately. Then those designated as such upon initial recognition or subsequently in accordance with India S 109 that financial assets whose credit risk exposure is managed through credit derivative that is measured at FETPL, and hence such a financial asset is also managed at FETPL. So firstly the financial assets are measured at FETPL will be shown in separately, or if any asset at the time of initial recognition itself it is designated. So we have discussed about relating to this. So if it is derivative other than written option, all will be shown in financial instrument, financial profit and loss. So if it is non-derivative assets or non-derivative liability, and if it is does not have credit risk or currency risk, then it will be transferred to P&L. So at the inception we need to see if it is financial assets, it is there any credit risk is manageable, and to credit derivative that method is FETPL, and hence such financial assets also managed FETPL. So what is the reasons we are measuring this FETPL, or we measuring for FEOCI or amortized cost? What is the reason, major reason we need to identify, and those mandatorily measured at FETPL in accordance with 109. We need to disclose this all. So firstly at the initial itself measured FETPL we need to show separately, and designated initially recognition or subsequently recognition that is mandatory for some conditions specified, we need to mention that conditions, and what are the mandatory items which are there we need to disclose those items. So next, if it is relating to financial liabilities at fair value to a P&L, we need to show separately. Same above what we are discussing here also same at the time of initial recognition or subsequent recognition, as we are following this India S 109 the financial liability, if it is have credit risk is exposed, credit derivative is measured at FETPL, and financial liability also measured at FETPL, and those items definition, as per definition it will meet the financial liability and is to measure at P&L, we need to disclose that item. So after that, if the assets, financial assets or financial liability is relating to amortized, we need to disclose it is amortized cost, and financial assets measured at FET OCI incomes then we need to separately disclose the financial assets are relating to OCI, these financial liabilities are relating to OCI. So simply we are discussing if it is FETPL we need to disclose, if it FEC OCI we need to disclose, if it is amortized cost we need to disclose separately. And financial assets or financial liability at FETPL. So if it is relating to FETPL, what is there? So firstly, categories of financial assets and liabilities we are disclosed. Now financial assets or financial liabilities at FETPL. So here the entity has designated at measured at FETPL financial assets or group of financial assets that would otherwise be measured at FE3 OCI or amortized cost. Then it shall disclose. What are the disclosures will be required? Firstly, what is the maximum exposure to credit risk of financial assets? So we need to see the credit risk. So because if it is as credit risk, it is not available option to maintain that item in PNL. So if it is have credit risk, it is not allowed in PNL. So we need to identify that credit risk financial assets. The credit risk, what is the maximum credit risk is exposure for this financial asset at the end of the reporting period, and the amount by which any related credit derivative or similar instrument mitigate the maximum exposure of credit risk, or is there any amount change or during the period or cumulative in the fair value of change of the financial assets, that attributable changes in credit risk of the financial assets determined the what is the amount change. So amount change in fair value that is not attributable to change in market conditions that give rise to market risk, or we need to use different alternative methods for the methods the entity believes which is mostly faithfully fully represented. The amount changes in its fair value that is attributable to changes in credit risk of the asset. Now we need to see what is the change in market conditions which that gives the market risk and includes changes in observed, that is interest rate, commodity price or foreign exchange risk index rate or rates. So we have different market conditions. For this we arise some risks, so we need to identify that one. Next, the amount of changes in the fair value of any related credit derivative or similar instrument that has occurred during the period and cumulatively since the financial assets was designated. So if the entity has designated a financial liability at FETPL in accordance with Ind AS 109 and he is required to present effect of changes in that liability credit risk OCI, it shall be disclosed. So we need to disclose that one. So what is the amount of change that is cumulating the fair value of the financial liability that is attributable to change in the credit risk. So firstly we need to see the amount change, and that amount change fair value of financial liability or what is the credit risk it is changing, we need to disclose that one. And is there any difference between the financial liability and the financial liability carrying amount and amount entity could contractually required to pay at the maturity. So what is there in our books and what we need to pay at the reporting period, what is the different, and for the different we need to disclose the reasons. And is there any cumulative gain or losses within equity during the period, include the reasons also. So if you are transferring any gains or loss to the equity, then we need to disclose that reasons for such transfer. And if liability is derecognized during the period, so the amount presented in OCI that is realized at derecognition. Next, if the entity has designated financial liability has at FETPL in accordance with Ind AS 109 and is required to present all changes in the fair value of the liability, so we need to include the effect of changes in credit risk of the liability in profit and loss, it shall be disclosed. Now first we need to see the amount of changes, the period and cumulative fair value of the financial liability which is the credit risk is there for that liability, we need to identify. And if it is relating to derivative or non-derivative, what is the difference between financial liability carrying amount and amount we need to pay at the contractually end maturity period. Next, if it is relating to that investment is relating to equity portion designated at FEC OCI, that is fair value through OCI. If an entity has designated investment in equity instrument measured at FEC OCI in accordance with 109, then what we need to disclose? So we need to disclose which investment in equity instruments have designated to be measured at FET OCI. So firstly we need to disclose which equity instruments are required to measure in FET OCI and reason for using that presentation alternative. So what are the reasons we are using that measure, and fair value of each such investment at the end of the reporting period. So what is the fair value you need to recognize, and dividend recognition. So dividend recognized, whatever the for equity we will get the dividend na, so dividends recognized during the period, showing separately that those related to investment de-recognized during the reporting period and those related to investment held at the end of the reporting period. So dividends. So and after that we need to see the any cumulative gain or loss within equity during the period, including the reason of such transfers. If entity de-recognize the investment in equity instruments measured at FET OCI income during the reporting period, it shall disclose. So if your entity is de-recognizing any equity instruments, then also we need to recognize some reasons. So firstly we need to recognize the reason for disposing the investment, or fair value of investment at the date of de-recognition, or cumulative gain or loss on disposal. Now when we are at reclassification, so for the reclassification what are the items we need to disclose? So if entity shall disclose if current or previous reporting period it has reclassified any financial assets in accordance with Ind AS 109. For each such event, an entity shall disclose what are the date of reclassification will be there, and detailed explanation of the changes in business model and qualitative descriptions of its effect on the entity's financial statements, and amount reclassified into and out of each category. So for the reclassification we need to date of reclassification, details what are the explanations they are providing for the change in business model and quantitative description, and amount reclassified into or out of each category we need to disclose them. For each reporting period, reclassification for each reporting period following reclassification until de-recognition is happened. Here an entity shall disclose for assets reclassified out of fair value to P&L category, so that they are measured at amortized cost or FET OCI. So what are the items we need to disclose? Effective interest rate, so determine on the date of reclassification, and what amount of interest revenue you are recognizing on that date, and if since its last annual reporting an entity has reclassified financial assets out of the FET OCI income category, so that they are measured at amortized cost. So how can they measured at amortized cost out of FETPL category, so that they are measured at amortized cost or FET OCI shall disclose. What are the items they need to disclose? Fair value of financial asset recognized in reporting period, and fair value of gain or loss that would have recognized in profit and loss or OCI during the reporting period if the financial assets are not reclassified. Next, offsetting financial assets and financial liabilities. An entity shall disclose at the end of the reporting period the following quantitative information separately for recognized financial assets and recognized financial liability that have been offset in accordance with Ind AS 32. Here what we need to disclose: what is the gross amount of this recognized financial assets and recognized financial liabilities. After that, amount set off in accordance with the criteria. So as per Ind AS 32, financial asset will be financial instruments. What is it? Okay. financial instrument when determining the net amount presented in the balance sheet. And what is the net amount presented in the balance sheet we need to disclose, and the amount subject to enforceable master netting arrangement. So if you have any netting arrangement, so at the time of inception of the contract we are entered netting arrangement. If it has netting arrangement or similar agreement, we need to disclose. Otherwise, information disclosure for amount set of para, including amount relating to recognized financial instruments that do not meet some or all offsetting criteria. So if it is not meet the offsetting criteria, means what is this offsetting? So for example, one person has payable and same person have receivable, so we need to offset this item. So for offset we need to see it is there as per provisions or not. If not there, what is the provisions, means rules explaining it is possible to net off or not, so we will see that item. So amount related to financial collaterals, including cash collateral and net amount after deducting the amount. Next, collateral means here the entity shall disclose the carrying amount of financial asset it has pledged as collateral for liability or contingent liability, including amount that have been reclassified in accordance with India AS 109 and terms and conditions relating to its pledge. When an entity holds collateral, that is financial or non-financial assets, and he is permitted to sell or repledge the collateral in the absence of the default by the owner of the collateral, it shall disclose fair value of collateral held, fair value of collateral sold, or terms and conditions associated with the collateral. So firstly we need to see about credit loss, allowance of credit loss. So for example, we have what amount is there in credit loss, what is the allowance for that credit loss. So the carrying amount of financial assets, so carrying amount of financial assets measured at FET OCI. So if it has allowance of credit loss, the carrying amount will be measured in FET OCI in accordance with India AS 109 is not reduced by a loss allowance, and an entity shall not present the loss allowance separately in the balance sheet has a reduction of carrying amount of financial assets. So however, an entity shall disclose the loss allowance in the notes to financial statement. So this loss item will be noted in the notes to account. Next, compounded financial instrument with multiple embedded derivatives. So here embedded derivative means what? First of all, derivative means what? Derivative means one contract which this contract value will change based on the underlying assets. So this underlying assets may be shares or bonds, whatever it may be, based on cases. So this is derivative. Embedded derivative means for this host contract there will be another will be attached. This attached amounts will change, will have more value, then it will be embedded derivative. So if it have compounded financial instruments, some cases compounded means the instrument which have equity plus debt option, these are also component financial instruments, or which they have multiple embedded derivatives. Then if the entity has issued an instrument that consists both liability and equity component, and the instrument has multiple embedded derivative whose value are interdependent, that is called convertible debt instruments, then it shall disclose the existence of those features. Next, defaults and breaches. Here for loan payable recognized at the end of the reporting period, an entity shall disclose. What are the entity needs to disclose? First, details of any default during the period, principal, interest, sinking fund, and redemption terms of the loan payable. So this all any default we need to disclose. So what is the period of principal, interest, sinking fund, redemption terms, what are there, these all we need to disclose. And after that, carrying amount of loan payable in default at the end of the reporting period. So what is the carrying amount? Next, whether the default was redeemed, remedied, or the terms of loan payable were renegotiated before the financial statements were authorized for issue. Now if during the period there were breaches of loan agreement terms, so they will provide some terms and conditions the terms and conditions were breached in during the period other than those they are existing at the year end and covered year end disclosure above. So if it has the year end means that contract came to expiry at time of expiry you are breach it does not impact more impact will be there or if it has during the cases then we need to disclose that same information as per required para. So what is the if those breach permitted the lender to demand accumulated repayment, so is there any penalty that amount we need to disclose. Next, statement of profit and loss account. Here entity shall disclose the following items, that is income, expense, gain or loss either on statement of comprehensive income or in the notes. Now we need to know about net gain or net loss on financial assets or financial liabilities measured at FETPL, showing separately those on financial assets or financial liability designated as such upon initial recognition or subsequently in accordance with the Ind AS 109, and those on financial assets or financial liability that are mandatorily measured at fair value through P&L in accordance with Ind AS 109, the financial asset that meets definition held in accordance for trading in Ind AS 109. Now if the financial liability is designated through fair value through P&L, entity shall show separately the amount of gain or loss recognized in OCI. So if it is FETPL and it has shown separately entity FEC OCI, then recognize the income amount recognized in the profit and loss account. Now then we need to disclose that all items. So FETPL items we need to disclose, and FET amortized cost we need to disclose, FET OCI we need to disclose this, and total revenue and total interest also we need to disclose. By this interest income and interest expenditure we need to use the effective interest method, so EIR method for financial asset that measured at amortized cost or amortized FET OCI, so we need to use the effective interest rate. And fees, income or expenses, financial assets or financial liability are not fair value through P&L, and trust and other fiduciary activities that result in the holding, investing of assets on behalf of individual trust, retirement benefits plans and other institutions. Next, other disclosures. What are the other disclosures? So accounting policies, we need to see the accounting policy. Here the entity disclose its significant accounting policy comprising the measurement basis that is or used in preparing the financial statement and other accounting policies used that are relevant to understanding the financial statement. So we need to see the accounting policies. What are the accounting policies? Now you need to see about hedge accounting. Hedge accounting means, what is meant by hedge accounting? Hedging means, hedge funds. What are the hedge funds will do? Firstly, these persons will take amount, so amounts from the HNI, that is high net worth persons or accredited individuals. They will collect money, pool money, and they will invest in different types of asset. They may invest in any asset, they may invest and they will get the profit, they will distribute. Here any assets means they will go for the derivative, they will go for the option, they will go for the shortage, they will go for the leverage also, they will allowed. So here main motive of this hedging is whatever the market, it may be bearish or it may be bullish, the objective is to get the profit is main motive for the hedge. So the type of hedge we need to accounting now. An entity shall apply those disclosure requirement for those risk exposure that an entity hedges and for which it elects to apply hedge accounting. So hedge accounting disclosure shall provide information about at entity's risk management strategy and how it is applied to manage the risk. So what are the information will be required to disclose? What is the risk management strategy for that entity and how that risk management strategy was applied, and how the entity hedging activities may affect the amount, timing and certainty of its future cash flows. So what are the future cash flows, how it will affect that activities, hedging activities. Next, effect of hedging accounting has add on the entity's balance sheet, statement of comprehensive income and statement of changes in accounting. So effects, what are the effects will be there, we need to disclose. So first, what is the risk, we need to disclose, and what are the effect for the future cash flows, we need to disclose. What are the entity hedge accounting effects, so what is affecting the hedge accounting balances, we need to disclose. And fair value, so fair value is also we need to disclose. For fair value, so for example I will explain here. So for fair value, normally we have three types: level 1, level 2 and level 3. So what is there in level 1, what is there in level 2, level 3? So in level 1, if you are able to identify the market, so you have market for your product, market is there, price is available and the price is reliable, then we will go with the L1. And if does not have the, for our product, we do not have the price to determination conditions, or price does not have for our product, then we will see the similar products. So here we will go with the similar product. Similar product, what is the price, we will discuss based on that. Here for our product itself, we need to see the price, and here we will see the similar assets price. Here in level 3, it is not possible to there, means we do not have active market. So here we have active market. We have active market. Here we have a similar price. For we do not have active market, active market is not there, but we have similar assets. Here we do not have similar asset, and plus we do not have active market, so both is not there. So for that type level 3, we can use some forecast, some projections we can use, some assumptions may use, some methods may use to calculate the value of assets. These are level 1, level 2, level 3. So for level 1, it has active market. For example, if you see that Reliance company is there, for that Reliance company, what is the share price, means you can go in the NSE or you can go with the BSE, and you can see that stock price as an dates. There we have so many buyers and so many sellers will be there. So when the persons, more persons is there, means it is reliable market. And L2, here the similar prices, means we do not have the price, fair value of the our assets, so we will see the similar assets. So for example, if you are have one building, for that building the price is not there, means active buyers are not there as of now. The opposite to your building, one building is there, they are sold, means they are purchased 1 month before. So what is the price, so we will see the similar asset value for the product. Our product price will be decided based on the similar assets. After that, we do not have the any information, we do not have active market, we do not have similar asset, then we will go with the some forecast, some projections, some assumptions. Here we decision will be taken based on that our estimations. What are the future cash flows, present value, discounting cash flow method we may use, comparable profits method they may use, different methods they may use for level 1, level 2, level 3. So for that, each class of financial assets or financial liability, an entity shall disclose the fair value of that class of assets or liabilities in way that permit it comparable to carrying amount. So they will disclose the carrying amount, they disclose the fair value. Entity group of financial assets, what is the fair value, but it shall offset only to the extent of their carrying amount offset balance sheet. Or if entity does not recognize gain or loss, initial recognition of financial assets or liability, because fair value is neither the evidence. So if does not have the quoted price in active market for the identical assets or liabilities, that is level 1. In level 1 what we have, quoted price have active market, and for the identical assets or liability. If here they are telling in negative sense, if that not have level 1 price, we will go with the another one, not based on the valuation technique that uses only data from the observable market, that is level 3. In such cases the entity shall disclose by class of financial assets or liabilities. So now the accounting policy for recognizing the profit or loss. So how you are recognizing profit or loss, is there difference between the fair value of initial recognition and transaction price reflect changes in factors the market participant would take into account when pricing the assets or liability. Next, aggregate difference yet to be recognized in the profit or loss at the beginning and the end of the period, and reconciliation of changes in the balance of different. And why the entity concluded that transaction price was not best evidence of the fair value, including description of the evidence that support the fair value. Next, disclosure of fair value is not required. In some cases we should not require. What when carrying amount is reasonable approximation of fair value. For example, for financial statements such as short-term trade receivables and trade payables. So if it is relating to short-term receivable or payable, it does not require to disclose the fair value, because they will realize within 12 months. For a contract containing a discretionary participant feature, that is if the fair value of that feature cannot be measured reliably. So for lease liabilities we should not require any disclosure as of now. In case contract with discretionary participant features where fair value cannot be determined reliably, the entity shall, when it is not able to determine the fair value, then the entity shall disclose information to help users of financial statement make their own judgment about the extent of possible difference between the carrying amount of the contract. Include here fact. What is the fact of fair value information has not been disclosed for this instrument, and because their fair value cannot be measured reliably. And what is the description? Here we need to see the fact, after that we need to see the description of financial instrument. So what is the carrying amount, what is the explanation why fair value cannot be measured reliably, and information about the market for instruments, and information about the whether how entity is intended to dispose the financial instruments, and if financial instrument whose fair value previously could not be reliably measured or de-recognized, the fact that carrying amount at the time of de-recognition the amount of gain or loss recognized. Now after that we need to recognize disclose nature and extent of risk arising from financial instruments. So entity also disclose information that enables users of its financial statement to evaluate the nature and extent of risk arising from financial instrument to which entity is exposed at the end of the reporting period. After that the disclosure describe how below focus on risk that arises from financial instrument and how they are managing. So they will see the focus on risk and how they are managing typically, but not limited to this credit risk or liquidity risk, market risk. These all are risk they must disclose, not restrict to this risk only. If they have any other risk they need to disclose. And some quantitative disclosures for each type of risk arising from financial instruments, an entity shall disclose exposure to risk and how they arise. So and objectives, policies and processes for managing the risk, and methods used for measuring the risk, and is there any changes, that is previous period. Next, quantitative disclosures. So for each type of risk arising from financial instrument include the credit risk, liquidity risk or market risk, the entity shall disclose. Here summary of quantitative data about its exposure to that risk at the end of the reporting period. This disclosure shall be based on the information provided internally key management persons of the entity. For example, board of directors or CEO, chief executive officer. Next, certain detailed disclosures required to for each type of risk mentioned about, or concentration of risk if not apparent from the disclosure. If quantitative data disclosed has at the end of the reporting period or unrepresentative of the entity's exposure to risk during the period, the entity shall provide further information that is representative. Next, if it is a credit risk, so credit risk also we need to disclose. An entity shall disclose 35F and 35N of India AS 109 to financial instrument to which the impairment requirement in India AS 109 are applied. So, however, for trade receivables, contract assets, lease receivables applies to those trade receivables or contract assets or lease receivables on which lifetime expected credit loss are recognized in accordance with India AS 109. More than 30 days past due, we need to disclose. And for credit risk disclosure described below shall enable users of financial statement to be understand effect of credit risk, the amount, timing and uncertainty of future cash flows. So, information about the entity credit risk management, quantitative and qualitative information about the credit risk we need to disclose. Credit risk management practices. So, an entity shall explain its credit risk management practices and how they relate to recognition and measurement of expected credit losses. So, to meet this objective, entity shall disclose the information that enable users of financial statement to understand and evaluate. Now, the entity, what is the credit risk, how the entity determine this is the credit risk, and initially recognition, and how the financial instruments will how low credit risk in accordance with India AS 109 classification to which applies, and presumptions of India AS 109 how significantly increasing this credit risk since initially recognition when financial assets are more than 30 days past due. And default, is there any default, it should be recognized. Is your grouped if credit losses, expected credit losses, how entity determine the financial assets are credit impaired financial assets, or entity written off right of policy including the indicator that there are no reasonable expectations of recovery and information about the policy for financial assets, or how the requirement in India AS 109 for modification of contracted cash flows of financial assets are applied, or determine credit risk of financial assets, expected 12 months expected credit loss, or monitor the extent to which loss allowance on financial assets meeting the criteria. An entity shall explain some inputs, assumptions, estimation techniques used to apply impairment requirements. So, impairment we will discuss it in another standard will be there, we will discuss. Now, basis of inputs and assumptions. The estimation techniques used for measure 12 months and lifetime expected credit loss, determine whether the credit risk of financial instrument has increased significantly since initial recognition, and determine whether financial assets is credit impaired financial assets. Now, how forward looking information has been incorporated in the determination of expected credit loss, including the use of macroeconomic information, and changes estimation techniques and significant assumptions made during the reporting period and reason for that changes. Next, quantitative and qualitative information expected for the loss. This all we need to disclose. And for the credit risk exposure, we need to disclose the credit risk exposure or loss allowance, how much is there for 12 months, and how much financial instrument increasing for financial liability, credit risk impaired on the reporting date, and trade receivables or contract assets, lifetime credit expected credit loss how much, and for all financial instrument to which impairment requirement is required not applied, and what is the best representative amount will be there, and what is the collateral security will be there for them asset we need to disclose. And after that, liquidity risk. So, for liquidity risk, the entity shall disclose what are the they need to disclose. One, maturity analysis for non-derivative financial liabilities. So, what is the maturity? And for the non-derivative financial liabilities, that shows remaining contractual maturity, or maturity analysis for derivative financial liability. Maturity analysis shall include remaining contractual maturities for those derivative financial liabilities for which contractual maturities are essential for an understanding of the timing of the cash flows, and description of how it manages the liquidity risk. So, they will disclose. After that, we have market risk. So, market risk also we need to see sensitive analysis what is there, and what are the methods and assumptions will be used, what are the changes from the previous period, on the methods and assumptions used. And if the entity prepares sensitive analysis, the what is the that is where means value at risk. It reflect interdependence between the risk variables and use it to manage financial risk. So it may use that sensitivity analysis in place of the analysis. Next, what is the explanation of the method and used in the preparing, such as security analysis and main parameters and assumptions underlying the data provided, and explanations of the objective of the method used and limitations used are results of information what are there we need to disclose. These all information we need to disclose. So what are the information we are disclosing? Market risk we are disclosing, liquidity risk we are disclosing, and credit risk we are disclosing. And after that, credit risk we are disclosing relating to credit risk management practices, how we are managing, and credit risk and quantitative details, nature and extent of financial instrument, arising financial instruments. And after the fair value, for fair value you need to see first level 1, if that not have level 1, which level they are using, level 1, level 2, level 3, we need to disclose that one also. And we need to disclose an accounting policy. So firstly we need to disclose about relating to accounting policies, what are the significant accounting policy is using by the entity. These all information we need to disclose in the notes to accounts.